Banks may currently have over $5 trillion in reserves, which means that number one, the Federal Reserve is much more likely to continue tightening for longer than people expect. And number two, that tightening may not be in lockstep with rates, meaning that rate hikes or rate cuts may in the future move independently of their balance sheet growing or declining. Historically, what we've seen is that when we are entering into an economically difficult period of time, the Federal Reserve will lower rates and then sometimes also increase its balance sheet. These are both tools that work together to provide more cash into the system to make conditions easier. And then when things become too overheated, basically they printed too much money, they're going to back off of that and they're going to start reducing their balance sheet, selling assets, and then hiking rates, which is exactly what they're doing right now. Since inflation has been a lot more sticky than many of the big brains expected ahead of time, people are now looking for inflation to come back down so that we can finally get on with our lives and stop seeing the Federal Reserve continue to tighten financial conditions by selling assets and hiking rates. But I'd like to show you guys an article. This is written by Joseph Wang. He's a former Fed trader, brilliant guy. Don't always agree with everything he says, but very smart, and he understands how these things work. I'll also be sending this article out in my weekly newsletter at the end of the week. This is a free newsletter. It's just a curation of a few of my favorite articles that I found throughout the week. You can sign up with a link in the description below. So Joseph Wang wrote this here from his website, fedguy.com, and goes through a few things that I'd like to point out. He talks about Governor Waller suggesting significant changes that removes all obstacles to continuing QT. The first thing is that the $2 trillion currently in the reverse repo facility should be considered bank reserves. Now, in practice, if they do look at the reverse repo facility funds as basically like reserves, that means that the total amount of reserves that banks have right now is way larger than what they officially have. Current reserve levels are around $3 trillion today, which is above the $2.5 trillion minimum requirement. But there's $2 trillion in the reverse repo facility, and this is the chart that I've shown you guys many times and talked about on many occasions, the reverse repo facility, a bunch of cash that banks have with the Fed. So again, that's over $2 trillion. So you put these two together and banks right now functionally have over $5 trillion worth of reserves. So why does this matter at all? Well, it matters because that means that the banks have a huge amount of liquidity to draw on, and there is no chance of a liquidity crisis anytime soon, despite the fact that the Fed may carry out tightening far into the future. Because historically, there's been a problem with the Federal Reserve kind of flip-flopping between easy and tight conditions, because you get to a point when you're tightening that the banks just can't survive any longer. One example kind of like this is in September of 2019 when the repo market exploded. The federal government had been borrowing so much cash from the banks that the economy was tapped out. There's no more cash left in the system. And so banks went to go get cash overnight like they do because it's all a big pawn shop, and there was no cash that anybody had to lend out. So that's when the Fed had to intervene, start not QE, buying up short-term assets again to try and inject money into the system through the regular repo market. And so when we have conditions that are tighter where the Fed's not actively trying to make conditions more liquid, you can run into a problem where there's not enough liquidity. There's a liquidity crisis. But ever since 2020, the problem has been the exact opposite. The federal government borrowed trillions of dollars, spent all that money into the economy, and now the economy is flush with cash. Banks have too much cash. Now, for those of you who kind of know more about the mechanics of the system, you might be thinking, well, wait a second. The federal government borrowed that money, so they created the liabilities, the treasuries, the collateral for the banks, while they spent that money, so they should offset each other. But you're forgetting the Federal Reserve monetized all that. So they sucked out all of those treasuries, all that collateral from the system. So all that new cash went into banks' hands without any additional collateral being available on the market. And that's why all that money eventually made its way into the reverse repo facility, creating a total of over $5 trillion in bank reserves right now. This means that the Federal Reserve has a huge buffer zone to draw on to continue to tighten, and the banks are in no chance of trouble from this. Now, you might think I'm saying that this is good news, but actually it means bad news for the American household, because the banks won't be in trouble. That doesn't mean your pocketbooks are not going to be squeezed. Your interest rates may continue to go up. Your costs may continue to go up. Your wages, your income might actually start going down. The American household can get squeezed. And since there's no banking crisis, no financial crisis, no liquidity crisis where the big boys are going under, the Federal Reserve can continue tightening, making things tougher, and don't have to worry about bailing anybody out. Joseph Wang points out that the actual QT run rate of $75 billion a month could continue for 3 more years, as long as they consider the reverse repo facility as reserves. But there's another curveball here, and that's the fact that the Federal Reserve may not want to continue to do both things in lockstep, selling or adding to their balance sheet and raising or cutting rates. Historically, they've done both of those things together. He points out here that it's a long-standing belief that you shouldn't step on the gas and the brake at the same time. So this opens up the doors for the Federal Reserve to start to separate those two policies and use those tools for different purposes. But why now? And what could those different purposes be? Well, I've said this before, but it's still my opinion that the federal government will be in trouble far sooner than the overall economy, than the financial system, than the banking system. It's probably not going to be in 6 months, but it's probably not going to be more than 2 to 3 years. As interest rates continue to go up, even if they stay where they're at right now, federal government costs go up every time they have to pay off old debt with new debt. They're exchanging 1% interest rate debt for 5% interest rate debt. And that's not even counting their increasing expenses every time they pass another $1.7 trillion omnibus bill. And so it's very likely the federal government gets to a point where they just simply can't pay the bills. In this case, that means that they can't borrow enough to pay off what they owe. At this point, the lender of last resort steps in, and the Federal Reserve lends to the United States government any cash that they need. The way this works is that their balance sheet goes up. They start buying more assets, treasuries. This allows the federal government to continue financing its operations without defaulting. But if they have to do this somewhat soon and they still have to fight inflation and they don't want to cause more inflation from this, then they're going to have to use their other hand to tighten. Give the federal government free money with one hand and tighten for everybody else with the other. And so it's very possible that we see that balance sheet start going up again soon as they bail out the federal government, at the same time continuing to raise interest rates to make sure everybody else is squeezed enough to not cause more inflation. Now, it's worth pointing out that in the article, what they are talking about is the exact opposite, that selling assets off the balance sheet might continue while rates are being cut. And he mentions that we might find out if the reverse of that is also true, which is what I've been talking about, and it's my opinion that the reverse of that, balance sheet going up while rates also go up, so you're tightening for the American citizen and easing for the federal government, I think that's a much more likely scenario. But the one thing that is absolutely undeniable here is that every time you bail out a system, you sow the seeds for a greater crisis down the road. And then when that crisis happens, you've set precedents that you have to intervene more to try and fix the problem, just like you did last time. Only this time, the problem is worse. And so the intervention that it took to save the system last time will be insufficient to save the system this time, which means that it's a question of when, not if, any amount of intervention becomes insufficient and the system does not survive. As always, really appreciate you guys. Thank you so much for watching. Have a great day.